Okay, let's unpack this with a phrase that is, I think, older than finance, older than banking, probably older than written trade laws itself.
You're talking about the eggs in the basket.
Don't put all your eggs in one basket. Exactly.
It is the ultimate piece of folk wisdom, right? It's applied to investing all the time, and yet the underlying mathematics, the economics of why that simple principle actually works are, well, they're often forgotten, even by really sophisticated investors.
And that's our mission for this deep dive. We want to gain knowledge quickly, but also thoroughly, about this foundational principle, financial diversification. We're going to try and go beyond the cliche.
Right.
We want to understand the real mechanisms of risk reduction, what the limits of diversification are, and maybe most importantly, debunk some of these persistent myths about how risk behaves over time.
At its core, it's just a risk reduction technique. That's all it is. It's the structured process of, allocating your capital across a whole variety of assets and exposures.
And the goal is to reduce your exposure to any single point of failure.
To any one particular asset failure or, God forbid, a catastrophic risk event.
And this is where the conversation and, frankly, the surprise really begins. You might think, just intuitively, that if you combine, say, 10 risky things, the total risk is just the average risk of those 10 things.
That's the common sense assumption.
But because of the way different asset returns interact with each other, a properly diversified portfolio exhibits this remarkable property. It will have less variance, so less volatility, less measured risk, than the weighted average variance of its parts.
It's so counterintuitive, isn't it?
It is.
You are actively combining volatile assets, but the combination is somehow calmer than the sum of its parts. Often, and this is the part that really gets people, the volatility of your entire diversified basket can actually be less than the volatility of the least volatile asset you hold inside it.
So long as they don't move in perfect lockstep.
Exactly. Provided they don't move in lockstep.
Yeah.
This lower variance, that's the prize we're all chasing.
And we should probably clarify, for those of you following along, that diversification isn't the only way to manage risk, even if it is the most sort of foundational. The other main technique is hedging.
Right. Hedging is much more of a tactical maneuver. It's about taking an offsetting position, maybe using a financial instrument like a derivative.
To mitigate a specific known risk.
A known risk factor, exactly, like currency risk or interest rate movements for a very specific period. Diversification, on the other hand, is strategic. It's a structural approach to just diluting risk across multiple, hopefully non-correlated assets, making the whole portfolio inherently more robust.
Rather than just shielding it from one specific danger.
Precisely.
Okay, so let's use the simplest and maybe the most terrifying example to illustrate this need for structural diversification. Imagine you, the listener, hold an entirely undiversified portfolio. You decide to put your entire retirement savings into just one company's stock.
You're facing maximum idiosyncratic risk.
And we aren't talking about, hypothetical disasters here. It is historically common for a single, even a large cap stock to drop 50% or more in a single year.
Oh, easily. A specific scandal, a major product recall, some new regulation, or just terrible management. It happens all the time.
And as you've pointed out before, recovering from a 50% drop requires a 100% gain just to get back to even.
The path back is brutally difficult.
So now contrast that nightmare scenario with one where you hold a portfolio of, say, 20 stocks, randomly selected from different industries, company sizes, maybe different countries.
The probability of that entire aggregated basket dropping 50% in the same year all at once due to unrelated catastrophic failures, it just becomes astronomically small.
The diversification kind of smooths everything out.
It eliminates the trends that are specific to one industry or one company class. That is the immediate visceral benefit you get. You're no longer betting on the fate of a single CEO. You're betting on the long-term health of the entire economy.
And this structural dilution of risk, it's not just limited to stocks and bonds in one country. Since, the mid-70s, the concept has really pushed aggressively toward geographic diversification.
That was a pivotal shift, especially for institutional investment. Managers began to heavily advocate for investing in emerging markets. Think Asia, Latin America, parts of Eastern Europe.
Places where the underlying economic growth rates were often much higher.
Higher than in the established G7 nations, exactly. And the argument was simple. By capturing those higher return rates, while at the same time reducing your overall portfolio risk, because those foreign economies don't move in perfect lockstep with your home market.
You generate superior risk-adjusted returns.
That's the holy grail.
So if the U.S. market is struggling with, I don't know, some internal political crisis, your exposure to booming manufacturing in Southeast Asia helps cushion that blow.
You're using the global economic cycle to flatten your personal volatility curve.
You're recognizing that the events that influence one market are not necessarily the same events that influence another. Okay, so we've firmly established that diversification reduces risk, it reduces volatility, but now we have to deal with the inevitable objection from any aggressive investor. What does this mean for my returns?
The big question.
If I'm deliberately choosing to spread my capital around, am I diluting my potential gains? Am I sacrificing my chance to find that next 100-bagger stock? Let's turn our attention from safety to the performance side of spreading your bets.
This is truly the essential, maybe even existential question for investors considering diversification. It speaks to a core psychological hurdle we all have.
It feels like you're choosing to be average.
It can feel that way. Let's look at the math first. When we talk about expected returns, and by that I mean our prior rational, data-driven expectations of the average returns on all assets, if those expectations are identical across all the assets we choose, then the expected return on the diversified portfolio will also be identical to the expected return on the undiversified one.
Okay, so if I buy 20 stocks that I think will have an average return, my portfolio's expected return is still just that average return. Diversification doesn't give me a free lunch where I get less risk and more average return.
That is the trade-off. Diversification is not an engine for increasing your average returns. Its core purpose is purely statistical. It narrows the range of possible outcomes.
It brings the goalposts closer together.
Exactly. The extremes, both good and bad, are mitigated.
Okay, let's unpack that mitigation. Why do I lose the extremes on the high side? That's the part that hurts.
Because you are now holding a weighted average of everything. In any given period, a group of investments will naturally have a spread of performance. There's going to be a winner, a loser, and everything in between.
And you don't know which is which ahead of time?
You don't, so you have to hold the whole basket. Therefore, the return on your diversified portfolio can never exceed the return of the single top-performing investment in your basket. Unless all the assets return the exact same amount, which never happens, the diversified return will always be mathematically lower than that single highest return.
That feels like the hard truth of diversification. You are deliberately, consciously sacrificing the chance to hit the jackpot. You are choosing not to chase the highest possible return.
And in exchange, you get certainty, or more certainty.
It's the price of safety.
It's the explicit price of safety. But look at the flip side, which is far more critical for long-term survival. Conversely, the return of your diversified portfolio will always be higher than that of the single worst-performing investment. By diversifying, you sacrifice the chance of achieving the maximum theoretical gain, but in return, you completely avoid the risk of suffering the maximum theoretical loss.
That distinction is paramount, isn't it? Especially for capital preservation. You're giving up the tail of maximum upside, that lottery ticket win, to completely chop off the catastrophic tail of maximum downside.
It stabilizes your returns. Diversification doesn't inherently boost or penalize your expected returns, but it makes them vastly more predictable. If your goal is preserving capital and ensuring a smooth journey toward a financial goal, that narrow path provided by diversification is really the only viable road.
It manages the inherent uncertainty of capitalism.
It smooths the path. It turns a jagged mountain range of potential outcomes into a gentle hill.
Which naturally leads us to the practical side, the how-to. If the goal is stability, how much diversification is enough? Is there a magic number of assets I need to hold before I can say, I'm safe?
This is a point of extensive debate in financial literature, and it's because there is no single magic number that just instantly transforms a high-risk portfolio into a low-risk one.
But there are rules of thumb.
There are. The number 30 stocks, is often cited historically, particularly in the context of achieving sufficient diversification within a single large equity market like the U.S.
Okay, so why 30? Is that based on some observation, or is it just a nice round number?
It's an approximation, really, informed by empirical data, which we'll definitely get into later. But the consensus among quantitative researchers suggests that the vast majority of the risk reduction benefit actually arrives much earlier than 30 stocks.
How much earlier?
A key finding, established as early as 1985 and validated many times since, showed that most of the measurable value you get from diversification, so the elimination of that company-specific risk, is achieved by incorporating just the first 15 or 20 different stocks into a portfolio.
So the heavy lifting is done by the 20th stock, and the 30th stock is just kind of polish.
That's a perfect way to put it. The overall principle holds. Adding more stocks generally leads to lower price volatility, but the marginal benefit, the risk reduction you gain by adding the 31st stock versus the 16th, it's statistically negligible.
That efficiency is so important for the average investor. If I only have the resources or, frankly, the time to research 20 companies, I've already done most of the risk mitigation I need to do.
You've neutralized what we call security-specific risk. By holding 20 different companies across different sectors, the risk that one specific CEO engages in accounting fraud
Or that one specific factory catches fire.
and shuts down the company's production line, that has almost no measurable effect on your overall financial well-being. That kind of company-specific disaster becomes an isolated, small event in your diversified landscape, rather than a catastrophe for your entire wealth.
So that baseline, maybe 15 to 20 assets, becomes the critical psychological threshold where you shift from a high-risk, concentrated approach to a structurally sound, low idiosyncratic risk portfolio. So we've established that, okay, 15 to 20 assets gives you enough basic diversification to handle that company's specific risk. But what if we want to go further? What if we want to achieve maximum diversification? What's the theoretical peak of spreading your capital?
The theoretical ideal, the thing that quants and academics are always chasing, is often described as buying the market portfolio.
That sounds like a concept ripped straight from an economics textbook.
It is, pretty much. The earliest and most influential formal definition of this maximum diversification came with the advent of the capital asset pricing model, or CAPM.
Which dominated financial thought from the 60s onward.
Right. And CPM posited that the perfectly diversified investor should hold a pro rata share of all available assets in the entire investment universe, weighted by their market value.
Okay, pro rata share of all available assets. What does that translate to in practical terms for someone listening today?
It translates directly to the modern index fund. When you invest in a fund that tracks the total global stock market, you are attempting to mimic this theoretical market portfolio.
Try to own a slice of everything.
You're achieving maximum diversification within that particular asset class, global equity, because you own a tiny piece of everything weighted by how big that thing is in the global economy.
That feels like the ultimate definition of dilution. If I buy the world, I can't possibly be destroyed by the failure of one specific company.
That's the logic. And theoretically, diversification has no maximum so long as more unique assets are available. Every equally weighted, uncorrelated asset you add will mathematically contribute to reducing your portfolio's measured variance.
But the real world is messy. As we saw in 2008 and during the pandemic, when a serious crisis hits, correlations tend to jump towards one. Everything starts moving down together.
A very real problem.
So how do the more advanced strategies account for assets that aren't uniformly uncorrelated?
This is where practitioners move beyond just market cap weighting, which simply uses market size to determine your holding. We move into alternative risk-based weighting approaches. And the first major strategy here is risk parity.
Okay, explain risk parity simply for us.
Risk parity aims to weight assets in inverse proportion to their historical or their forecasted risk, which is usually measured by volatility.
So if stocks are twice as volatile as bonds,
A risk parity strategy would dictate holding twice as much value in bonds as in stocks.
wait, so instead of measuring my portfolio's contribution by dollar value, I'm measuring its contribution by risk.
Exactly. The result is a portfolio where every asset class, be it commodities, stocks, bonds, real estate, contributes an equal amount of risk to the overall portfolio volatility.
And why do it that way? What's the justification?
It's highly pragmatic. Forecasting future risk or volatility is statistically much easier and more reliable than forecasting future market prices or economic growth. So you're structuring the portfolio around a known quantity risk contribution rather than an unknown quantity future return.
That's a fascinating inversion of the typical approach, which is always chasing returns. This chases stability.
And this leads to an even more nuanced approach, correlation parity. This is a further refinement. Instead of just aiming for equal volatility contribution, like in risk parity, correlation parity tries to structure the portfolio so that each individual asset has an equal correlation with the overall portfolio itself.
So, how does balancing correlation beat balancing volatility?
Well, think of volatility as the speed of a car, and correlation is how many other cars on the road follow your exact speed changes.
Okay.
Risk parity ensures every part of your portfolio is equally responsible for the overall speed bumps. Correlation parity tries to make sure every part is equally independent of the overall portfolio's movement. In mathematical terms, it's considered the true, most diversified portfolio because it aims to reduce shared dependency across the board.
So risk parity is just a special case of it.
It's a special case of correlation parity that only applies if you assume all the correlations are uniform. These complex methods exist because they recognize that correlation, fundamentally, is the chief enemy of effective diversification.
Okay, let's bring it back to the CAPM model, because it is so crucial for our listener to internalize the distinction the model introduced. We have to define the two faces of risk clearly.
This separation is the true genius of modern portfolio theory. The first type of risk is the one we can get rid of, diversifiable risk. It's also called idiosyncratic risk, unsystematic risk, or security-specific risk.
Give us a concrete example of diversifiable risk.
Let's say you own shares in ExxonMobil. If a specific oil rig malfunctions or they lose a patent on a specific drilling technology, that incident only impacts ExxonMobil.
It's specific to that company.
Right. And because it's only one company in the S&P 500, you can effectively dilute or eliminate the financial impact of that one event by holding the other 499 stocks.
And the risk we absolutely cannot eliminate, no matter how clever we get.
That is the non-diversifiable risk. We also call this systematic risk or market risk, and it's often quantified by an asset's beta.
So if you own an index fund tracking the entire S&P 500,
You are still exposed to movements of that index as a whole. No matter how many individual stocks you buy within that market, you cannot eliminate the risk that the entire market dives due to a coordinated recession, a sudden spike in inflation, or a global war.
because that risk applies to all companies, more or less.
Directionally, yes, it applies to all of them.
So the TAPM's argument is essentially, stop worrying about the risk you can control. Focus on the risk you can't.
Absolutely. And they made an extremely powerful logical leap about compensation. They argued that investors should only be financially compensated, meaning they should only expect a premium return for bearing non-diversifiable risk.
And the logic there is,
The logic is unassailable. Diversifiable risk is entirely within your control as an investor. If you choose to hold only one stock and you suffer a 50% loss due to a management scandal, the market views that as a self-inflicted wound.
the market doesn't pay you extra just for failing to diversify,
It does not. It creates an efficient market structure where unnecessary risk is not rewarded.
which puts the onus entirely on the investor.
It does. But, in this pursuit of maximum diversification, we have to introduce a necessary practical caveat: the danger of over-diversifying.
Over-diversifying. How can too much of a good thing possibly be bad?
Well, while mathematically every uncorrelated asset helps, practically, diversification has to be cost-efficient. If you start adding assets where the per-asset investment fees, the transaction costs, or just the increased monitoring expenses begin to outweigh the marginal tiny gains you get from more diversification.
Your net portfolio performance will suffer.
Exactly.
That was a much bigger problem, say 30 years ago, when mutual fund fees were high and trading was expensive.
For sure. But even today, if you're actively trading small amounts of complex, illiquid assets, those fees or just the difficulty of managing a massive number of positions can quickly consume that marginal risk benefit.
It's a pragmatic warning.
It's a warning that the pure quantitative models sometimes overlook. The theoretical pursuit of maximum diversification must always be tempered by the practical costs of execution.
All right, let's move beyond the theory and get into the engine room. We've claimed that diversification lowers variance even if assets aren't perfectly opposed. How does the math actually make this magic happen?
We have to look at the mathematical structure of variance, which is our formal measure of risk, sigma squared. The beauty of diversification lies in the fact that when you combine assets, you're including both their individual risk contributions and, critically, their shared risk relationship, the covariance.
Let's start with the base case again. Two perfectly uncorrelated assets, X and Y. Zero covariance.
So we use our simple thought experiment. A total portfolio of, say, W dollars. You invest a fraction Q into asset X, and the remaining fraction 1 minus Q into asset Y.
Okay.
Because we assumed zero correlation, the formula for the portfolio variance, sigma P22, it simplifies to 2Q sigma X2 plus 1Q2 sigma E22.
And I see the crucial element right there. The portfolio variance is the weighted sum of the individual variances, but the weights, the Q and the 1 minus Q are squared.
They're squared. And since Q and 1 minus Q are both less than 1, their squares are even smaller.
Right, if Q is a half, 50-50 weighting, then Q squared is a quarter.
Precisely. So instead of each asset contributing 50% of its risk, it contributes only 25% of its risk to the total variance pool. It's the squaring of the weights that creates this geometric reduction in risk. And furthermore, mathematically, you can always find a specific variance minimizing weighting, a Q, that is strictly between 0 and 1.
Which proves that the most stable portfolio requires holding both assets.
It demonstrates that diversification reduces risk below the level of even the least volatile single asset.
That's the core mathematical proof. Even if the assets offer zero benefit from offsetting movements, just subdividing your capital across them immediately kills a portion of the total risk.
And this favorable effect is, of course, enhanced exponentially if the assets are negatively correlated. One goes up when the other goes down, creating a natural hedge.
And it's diminished but not eliminated if they're positively correlated.
Diminished but still present, assuming the correlation is not perfectly positive, not equal to +1.
So let's scale this up dramatically. What happens when we look at n assets, all equally weighted, mutually uncorrelated, and they all have the same individual variance, sigmax 222?
The resulting portfolio variance simplifies to this elegantly clear expression: sigma p22 equals sigmax 22 divided by n.
That is beautiful in its simplicity.
It is. The portfolio variance is simply the individual asset variance divided by the number of assets you hold. This result is mathematically monotonically decreasing as n increases.
Meaning it only ever goes in one direction.
Downwards. As you add more and more uncorrelated assets, the risk only ever goes down. If you start with 10 assets and you double your holdings to 20, you cut the variance in half. This is the clearest possible mathematical statement on the power of diversification.
But we need to spend a moment on a critical technical distinction that financial theory demands. The difference between true diversification and simply adding risk. You brought up the example of an insurance company.
Yes. When we talk about sigma squared divided by n, we are defining diversification as subdividing a fixed total amount of capital. We have one pie, and we slice it into n pieces.
Right.
Now consider the opposite scenario, as explored by thinkers like Paul Samuelson. What if an entity is simply aggregating independent risks?
Like an insurance company adding policy X1, then policy X2, then X3, and so on?
Exactly. Each policy is an uncorrelated, volatile risk. If the insurance company simply adds n uncorrelated policies without changing its capital base, the total variance of their exposure is n times sigma squared.
The variance is increasing.
It's increasing linearly with n. They are adding risk, not diluting it.
That's a key conceptual barrier. The insurance company becomes riskier the more policies it writes, all else being equal.
The company aggregates the risk. The diversification, in this case, doesn't happen at the corporate level by writing more policies. It happens when that risk is ultimately dispersed among the company's investors, the shareholders, who spread their investment across many companies and other asset types. The company aggregates risk, the investor dilutes it.
Okay, that's the theory, that's the mathematical scaffolding. Let's make this palpable for the listener by looking at the classic empirical proof, the study that quantified exactly how fast this risk falls off. We're talking about the 1977 work by Elton and Gruber.
This study is the bedrock of the how many stocks are enough debate. They looked at a huge population of available securities and calculated the average risk, the standard deviation of annual returns over all possible randomly chosen portfolios of size n with an equal amount held in each asset.
The power here is that it wasn't theoretical, it was based on historical market data. So let's look at the steepness of that risk reduction curve.
For a portfolio with just one stock, they found the average standard deviation was 49.24%. That is maximum idiosyncratic risk. We'll use that as our baseline, a ratio of 1.
Now, watch the immediate return on diversification. How much risk is killed by just adding 3 more stocks?
With 4 stocks, the standard deviation plummeted to 29.69%. That's a ratio of 0.60.
So you eliminated 40% of the total measurable risk just by going from 1 to 4.
40%. That is the massive initial gain we were talking about.
And if we move up to 20 stocks, which is that comfortable threshold for eliminating idiosyncratic risk?
At 20 stocks, the standard deviation was 21.68%, a risk ratio of 0.44. So 20 random stocks reduced the risk to less than half of what a single stock entailed.
And moving from 20 to the historical benchmark of 30.
At 30 stocks, the standard deviation was 20.87%, a ratio of 0.42. The incremental benefit of those extra 10 stocks was minimal.
Just 2% more risk reduction.
Tiny.
And here's the truly astonishing part. Let's compare that 30 stock figure to a maximally diversified holding of 1,000 stocks.
At 1,000 stocks, the risk reduction essentially flatlines. It drops only slightly further to a standard deviation of 19.21%, a ratio of 0.39.
The ultimate takeaway for the listener is just undeniable here. 4 stocks capture nearly half the benefit. And the risk level you get with 30 stocks is extremely close to the risk level of holding 1,000.
The curve flattens out so rapidly. Beyond that point, that residual risk, that 39%, that is the non-diversifiable systematic risk.
It confirms that your effort should be focused on building that core, diversified portfolio of 15 to 30 well-chosen non-correlated assets rather than inefficiently trying to replicate the market through thousands of individual high-cost trades. We've established the quantitative rules for the individual investor, but these same concepts of risk and correlation, they apply at the corporate level too. Large companies also have to manage risk, not just of single assets, but of entire product lines or, geographical regions. Let's explore corporate diversification strategies.
When corporations diversify, they're generally doing it for stability, either internally within their supply chain or externally against market volatility. The 3 common forms really just define their relationship to the core business.
Okay, start with horizontal diversification.
This is the most common and often the lowest risk approach. It involves expanding a product line that uses existing resources or acquiring companies that operate adjacent to the core business.
So a soft drink company starts selling energy bars.
Perfect example. They already have the distribution networks. They have the marketing muscle. They're just expanding the product offering horizontally.
And vertical diversification. That sounds like capturing the supply chain.
Precisely. Vertical integration is all about consolidating steps in the value chain, amalgamating distribution channels, or integrating the supply chain. A large automaker might buy a lithium mining operation.
Or a software firm that writes their in-car code.
Exactly. The goal is efficiency, cost control, and securing critical inputs, which mitigates the risk of supply disruptions.
And then the most aggressive form, one that has fallen in and out of favor dramatically over the decades, non-incremental diversification.
This is the strategy of the pure conglomerate. It involves acquiring or launching business lines that have little to no connection to the company's core activities. A classic example would be a company that simultaneously owns aerospace manufacturing, a commercial real estate portfolio, and a media publishing house.
The famous example being Berkshire Hathaway, although they'd argue their strategy is more about capital allocation than traditional operational synergy. Why adopt such a disconnected approach?
The theory is purely diversification-driven. It's to stabilize the overall company's earnings by mitigating external exogenous risk factors. The hope is that when the aerospace cycle is depressed, the commercial real estate market might be booming, or vice versa.
The different lines smooth out the total income flow.
They provide stability to shareholders and often lower the overall cost of capital for the entity, although the complexity of managing such disparate businesses is often what ultimately leads to conglomerates being broken up.
It's corporate diversification applied on a grand scale. You're trying to kill the systematic risk of specific sectors by owning a basket of uncorrelated sectors.
Exactly, and its success often relies entirely on management's ability to allocate capital effectively across those disparate businesses, not on operational synergy.
Now let's pivot to a point that you need to be very clear on, because it impacts retirement planning for virtually every single person listening. The fallacy of time diversification. This is the belief that time itself is a risk reducer.
This belief is so deeply rooted in investor psychology, it's taught widely in personal finance. The argument goes that because younger investors have decades until retirement, they should aggressively favor risky assets like stocks.
Because they have time to recover from any downturns.
Right. The underlying and very misleading premise is that over long periods, the good returns will mathematically cancel out any possible bad returns, making the long run safer.
It's that comforting voice that says, don't worry about the market crash today. You have 30 years left.
And while that voice is attempting to calm panic, it fundamentally misrepresents how risk operates over time. The flaw was definitively identified by Nobel laureate Paul Samuelson, among others like John Norstad and Zvi Body.
So what's the flaw?
While it is true that the standard deviation of annualized returns decreases as the investment horizon increases, meaning your average yearly return becomes more stable, that is not the measure the retiree actually cares about.
The retiree cares about the final dollar amount, the total return.
Precisely. The uncertainty that matters is the final outcome. And due to the inexorable power of compounding, the standard deviation of the total return, the uncertainty surrounding your final accumulated wealth, actually increases dramatically with the length of the time horizon.
Let's visualize that. If I invest for 1 year, the range of possible outcomes from my final capital is relatively small, right? Maybe I earn 10% or I lose 10%.
Correct. But if you invest for 40 years, the range of possible total returns, due to the cumulative effect of those annual gains and losses compounded over 4 decades, is exponentially larger. The absolute risk to your final nest egg is greater, not less, the longer the timeline.
So uncertainty, measured as the standard deviation of my total dollar return, increases with time.
It increases with time.
So if I start with $10,000 and I have a 40-year horizon, my best case scenario might be $5 million, but my worst case scenario might still be $50,000 depending on the sequence of returns.
And the spread between those two numbers is the standard deviation of your total return. And that spread is massive.
That's huge.
The fallacy grants investors a false sense of security. It encourages them to concentrate their portfolio in high-risk assets based on the mistaken belief that time acts as a natural systematic hedge. It does not. It magnifies potential outcomes.
So long-term investors need diversification across asset classes, stocks, bonds, real estate, just as much as short-term investors.
Absolutely. Simply to manage the volatility of that massive final wealth number.
That reframes the entire purpose of diversification for a young person. It's not about surviving the next quarter. It's about controlling the enormous uncertainty inherent in a multi-decade compounding experiment.
It's really remarkable that an economic concept so mathematically complex in its modern form has such simple, ancient roots. Diversification, in its core form, is just applied common sense about survival.
So let's trace this back through time. Where does the concept first appear in written history as a piece of financial advice?
We can trace the concept back to the Bible, specifically the book of Ecclesiastes, which is often dated around 935 BC. The text offers this remarkably relevant financial advice.
Easy to say.
But divide your investments among many places, for you do not know what risks might lie ahead.
That is nearly 3,000 years of consensus. The underlying concern is identical to modern risk management, preparing for unknown future risks.
And another ancient source provides a highly specific prescriptive asset allocation that is still studied today, the Talmud. It details a specific financial strategy for wealth management.
What was the Talmudic formula?
The Talmud advised splitting one's assets into thirds. 1/3 was to be held in business, so active trading and commerce. That was your high-risk, high-growth engine.
Okay.
The second third was to be kept liquid, perhaps in the form of gold coins or readily available cash. This was the stable zero-risk component. And the final third was to be invested in land or real estate, representing the long-term, inflation-protected tangible asset.
That is sophisticated risk management. You have a growth engine, a safety net for liquidity, and a stable store of value protected against economic turmoil.
And this approach is now recognized in modern research as naive diversification or one-end diversification because it instructs the investor to split wealth equally among the available major asset classes.
And it actually works.
Research since the year 2000 has shown that, surprisingly, this simple one-end allocation strategy often performs remarkably well compared to much more complex optimization-driven models, especially during periods of high market volatility. The ancient wisdom holds significant practical value.
And we even see this concept woven into the fabric of Renaissance literature, reflecting how crucial it was to global trade back then.
You just have to think of Shakespeare's Merchant of Venice, written around 1599. The character Antonio, whose entire fortune is tied up in global shipping, states that his ventures are not in one bottom trusted, nor to one place.
He's talking about ships and ports.
Bottoms and ports, exactly. He fully understands that he has to mitigate the risk of piracy, storms, or a single port closure by spreading his ventures across multiple vessels and geographic routes at the same time.
So the principle was intuitive for millennia, driven by the realities of physical risk. But the move towards scientific quantitative measurement, the transition to modern portfolio theory, that's where Harry Markowitz steps in.
Markowitz's seminal work in the 1950s provided the necessary mathematical language. He moved the conversation from don't put all your eggs in one basket to we must calculate the covariance between the returns of the eggs to achieve optimal risk reduction.
MPT.
Modern portfolio theory.
Okay.
It formally defined how to get the highest possible return for a given level of risk, or conversely, the lowest possible risk for a target return.
But even before Markowitz formalized MPT, our sources highlight a major financial figure who was practicing sophisticated, intuitively driven diversification decades earlier, John Maynard Keynes.
Keynes's tenure managing the King's College, Cambridge endowment from the 1920s to 1946 is legendary. He was, by modern standards, sometimes highly concentrated in his stock picks, but his underlying philosophy was profoundly diversified in the right ways.
So what defined his risk management philosophy in a time without modern derivatives or index funds?
He was focused on the structural relationship between assets. He recognized the crucial importance of holding assets with opposed risks.
Meaning things that were likely to move in opposite directions.
Exactly. Assets that would move in opposite directions during general market fluctuations. He was intuitively grasping the power of low or negative correlation, the key mathematical insight Markowitz later formalized. He understood that while an individual asset might be volatile, if you paired it correctly, the portfolio could be stable.
And he was a pioneer in a geographic sense, too. He was avoiding that infamous home bias.
Oh, absolutely. Keynes was a true maverick in this regard. He aggressively invested internationally, holding significant portions of the portfolio, sometimes as high as 75% in non-UK stocks, primarily U.S. equities.
Which was revolutionary at the time.
It was. In the 20s and 30s, nearly all university endowments in both the U.S. and the U.K. were heavily, often entirely, invested in domestic bonds and local assets. Keynes recognized that the risks facing the British economy were idiosyncratic on a global scale, and he used international diversification as a core risk mitigation tool decades before it became institutional standard practice.
That global perspective, based on observing risk factors rather than just relying on local comfort, really cements his position as a crucial historical figure in risk management. #tag outro. We've taken a very deep dive into this foundational principle. Let's try and synthesize the core knowledge points that you can take away right now. First and foremost, diversification is a risk management tool.
That's it.
It's designed to stabilize your returns, dramatically narrow the range of possible outcomes. It is not a mechanism for boosting your expected average returns.
Second, the empirical evidence that Elton and Gruber study, it gives you a clear, actionable threshold. The most impactful risk reduction happens very quickly. Holding 15 to 20 well-chosen non-correlated assets captures the vast majority of the benefit available. It eliminates company-specific risk with high efficiency.
And finally, ditch the comforting but misleading advice about time. Time does not reduce the uncertainty of your total final wealth. Due to compounding effects, a longer time horizon actually increases the standard deviation of your total return. This demands that long-term investors still rely heavily on diversification across asset classes to manage that enormous potential spread between their best and worst case retirement scenarios.
And to leave you with one final provocative thought that circles back to where we started with systematic risk, let's just recall the asymptotic limit of diversification. We established that as the number of assets, N, approaches infinity in a maximized, equally weighted portfolio, the portfolio variance does not go to zero.
It bottoms out. It hits a floor.
Exactly. The variance tends asymptotically toward the average of the covariances between all the securities, what we call DOM or sigma D. This shared risk, this average relatedness of all the assets, that is the ultimate non-diversifiable risk.
The systematic risk that is woven into the fabric of the entire market.
It's the risk that's left over.
So if mathematically, even infinite diversification cannot eliminate the risk shared by every asset in the economy, what does that tell you about truly safe investing? How can an investor truly escape systematic risk if the entire global financial system is wired together by shared economic and geopolitical factors? That is the ultimate challenge for any serious investor to contemplate.